Okay, let's unpack this. We are diving into Netflix today. I mean, a company whose scale is almost hard to wrap your head around sometime.
It really is. They basically invented the streaming playbook, right? They're dominant globally,
Huh.
reaching over 500 million people. That's across 190 countries.
Yeah.
It's huge.
Absolutely. And, when you look at their history, it's not just a success story. It's like they built the whole industry.
And that level of growth, it means every single move they make, well, it sends ripples everywhere, especially in the financial world.
Yeah. And the stock, it absolutely reflects that. We looked at the data, and just over the last year, shares climbed 44%.
Wow.
And if you zoom out, look back 10 years, the stock's up a staggering 936%.
Incredible numbers.
Which is exactly why this recent announcement they made is getting so much buzz.
Exactly. And this time, it's not really about subscriber numbers, which is what we usually talk about with Netflix. It's structural. They announced a massive stock split. So our mission today really is to cut through all the noise around this. We need to figure out, is this split a real fundamental reason to maybe buy? Or is it more like market psychology, just noise?
That's the million-dollar question, isn't it? Or maybe the $1,100 question in this case.
Yeah.
So what exactly did the board approve here? And critically, when's this all happening?
Okay, so they dropped this news right after their Q3 earnings report. And the details, they're actually pretty straightforward.
Okay.
The board signed off on a 10-for-1 stock split, which, by the way, is pretty rare for them.
Huh?
This is only the third time in the company's entire history they've done that.
Oh, okay. Third time ever. And 10 for 1, that's a big ratio. So let's make this really concrete for you listening.
Yeah.
If I owned one share, let's say it was trading around $1,100 before all this, what happens to my portfolio after the split?
Right, good question. So after the split, your single $1,100 share becomes 10 shares. And each of those 10 shares is now worth $110. The really crucial point here is that the total value of your investment, it stays exactly the same, $1,100, but the price tag on each individual share drops way down.
Gotcha. Same total value, just more smaller pieces.
Yeah.
And the timeline is super important for anyone holding the stock, right? Because this isn't instantaneous.
Correct. Yeah, the key dates are coming up pretty fast, actually. So if you were listed as a shareholder on the books as of Monday, November 10th, 2025, then you qualify.
Okay, November 10th.
Then you'll get those extra 9 shares for every 1 share you own. That happens after the market closes on Friday, November 14th.
Friday the 14th.
And then the stock starts trading at its new split-adjusted price when the market opens the following Monday, November 17th.
Okay, that sounds like it could be a huge administrative lift, for brokerages dealing with millions of shares. Why don't I, as an investor, have to fill out a bunch of forms or something?
Yeah, that's a great question, and thankfully you don't. This is all handled behind the scenes by your broker or your investment bank. They manage the mechanics, they adjust the ledger in your account, deposit those 9 extra shares. You literally don't have to lift a finger.
But there's always a catch, right? Or some fine print.
Well, yes, a small caveat.
Yeah.
Just given the sheer volume, the complexity of doing this across the whole market, those extra shares might not pop up in your account like magic right at 9:30 a.m. on the 17th.
Ah, okay, so don't panic if they're not there immediately.
Exactly. It could take a few days for everything to settle and for you to see all 10 shares reflected correctly in your account. So
Yeah.
patience is key there.
All right, so we've got the, 10 for 1 split, went mid-November. Now, let's get to the why. If I wake up on November 17th, look at my portfolio, and the total dollar amount hasn't changed, why should I care? I mean, is a stock split actually good for investors?
Well, objectively speaking, purely in terms of fundamental value, no.
Yeah.
It changes absolutely nothing.
Right.
It's the same company, same assets, same revenue streams. Everything's identical. It's just divided differently.
It's like having the exact same pizza, right? But instead of one giant slice, now you've got 10 smaller slices. Still the same amount of pizza.
That's the perfect analogy.
Huh.
Or the sources used a cash example. And it doesn't matter if you have one $10 bill or 10 $1 bills, right? You still have $10.
Okay.
Same thing here. You just own more shares, but each one's at a lower price.
Yeah.
Total value. Identical.
But wait a minute, if the total value is the same, why does anyone even bother? Why all the fuss? This must be where that investor psychology thing kicks in.
Bingo. That's exactly it. And this is where the split kind of becomes, well, market noise, potentially.
Okay.
The company actually stated their internal reason pretty clearly. They said they wanted to, and I'm quoting here, reset the market price of the company's common stock to a range that will be more accessible to employees who participate in the company's stock option program.
Oh, that's fascinating. So it's directly tied to their own employees.
Yeah.
To internal compensation, making those options feel more manageable, maybe?
Exactly. It's about motivating their own team, making those options maybe seem less daunting, more tangible for employees at different levels.
Okay, that makes sense internally, but obviously that affects spills outside the company too, right?
Oh,
Sure.
absolutely. The practical effect is wider. Taking the price down from over $1,000 to around $110, undeniably that makes the stock look and feel a lot more accessible to, retail investors.
Hmm.
The everyday person trading from home who might balk at shelling out $1,100 for just one share.
Right. So that feeling, that psychological boost of, hey, I can buy 10 shares now instead of just one, how much does that feeling actually move the needle in trading? Is there like historical proof this works?
History definitely suggests it does have an impact. Yeah.
Mhm.
There was an analysis done by Bank of America, and they found that companies completing stock splits tend to see their stock price gain about 25% on average in the year after the announcement.
25%. Whoa. Okay,
Yeah.
that's pretty significant. How does that compare to the overall market?
Well, for comparison, the broader S&P 500 averages maybe 12% gain in a typical year during the same kind of period.
Okay, so nearly double the average market return. So it seems like while the split itself doesn't create new value, it often acts like a signal flare, maybe, highlighting strong performance that the market then continues to reward.
That's a great way to put it. The split shines a spotlight, draws attention to a company that's usually, already doing well.
Mm-hmm.
And if we connect this back to the bigger picture, it really underscores that a stock split is fundamentally secondary. It's all about the underlying operational performance,
Mm.
which means we got to dive into Netflix's actual numbers, their financials, to find the real signal here.
Okay, let's pivot then. Forget the split for a second. What's the core business telling us? Is Netflix still firing on all cylinders, even with all the competition out there now?
Oh, they are. The data is really robust. If you look at the first 9 months of 2025, their revenue grew 15% year over year.
Yeah.
That hit $33.1 billion.
15% growth on that scale is pretty impressive.
It really is, especially in what you'd call a maturing industry.
Yeah.
And crucially, their earnings per share, the profit per share, that climbed 26% to $20.12.
Okay, solid growth, top and bottom line. But the number that really jumped out at me from the sources, the one that kind of screams efficiency, is the operating margin.
Yes. This is, I think, the most important metric we've seen here. Operating margin tells you how much profit they squeeze out of their core operations after paying for all the content, marketing, admin, everything.
Right.
And Netflix's operating margin, it hit 31.3% in 2025, year to date.
31.3%. That seems incredibly high for a company that spends billions making movies and shows. How does that stack up against competitors?
Yeah, in this industry, hitting over 31% is exceptional. When you look at major players like Disney Plus, Seed, or Max, or others, they're often fighting to get margins in the high teens, maybe low 20s for their streaming divisions.
Mm.
They often have legacy costs, restructuring. Netflix is pure streaming, and they've achieved a scale and efficiency that, frankly, their rivals envy.
So what does that trend tell us? The sources showed it was like 21% in 2023, then 27% in 2024, now over 31%. That's a huge leap.
That trajectory, jumping roughly 10 percentage points in just 2 years, it tells us management has gotten incredibly disciplined with spending.
Okay.
They're still investing massive amounts in content, obviously, but they're clearly getting more bang for their buck. It suggests, smarter content choices, maybe better production cost control, and definitely benefiting from their different pricing tiers, like the ad-supported plan. They're just dropping way more revenue down to the bottom line.
And speaking of content, that amazing margin performance, it only works if they keep people watching, right? So what's the pipeline look like for Q4? Any big hitters?
Oh yeah, Q4 looks absolutely stacked. It seems like a guaranteed audience magnet. They got the final season of Stranger Things.
Huge. Always huge.
Always drives massive engagement, yeah. Plus, new seasons of other big fan favorites. The Witcher, nobody wants this. Emily in Paris, Love is Blind. The list goes on.
And they're really leaning into live sports now, too, aren't they? That NFL Christmas Day doubleheader sounds massive. Cowboys versus Commanders, Lions versus Vikings. That's appointment viewing.
Exactly. That's a major draw. Keeps people sticky. And then add in the big prestige movies they have coming. Guillermo del Toro's Frankenstein, Rian Johnson's new Knives Out mystery, Wake Up Dead Man.
Oh, okay.
Put it all together, and the picture suggests, continued strong subscriber engagement, strong pricing power going forward.
Yeah.
That's the real underlying signal.
Okay, so fantastic execution, incredible margins, blockbuster content. But The stock isn't exactly cheap, is it? The sources said it's selling for like 34 times next year's expected earning.
That's right. It is undeniably a premium valuation, no question. It's high, especially maybe when you consider the forecasts for revenue growth around, say, 12% annually over the next 5 years. Only 12%, some might say.
Yeah, 34 times earnings for 12% growth. That sounds kind of steep. So where's the justification for paying that premium? Why are alarm bells ringing louder on the valuation?
Yeah, it's fair to question that multiple. I think the justification really comes down to two things: their competitive moat and that efficiency story we just talked about.
Okay.
First, they are the clear market leader. They have the brand, the scale, and as we saw, the highest profit margins by far. That's a powerful moat.
Right.
Second, while 12% revenue growth might not sound explosive like some tech stocks, it's seen as pretty steady, pretty reliable, especially compared to the volatility you see elsewhere in media right now. So investors seem willing to pay that premium for the stability, plus management's proven ability to keep expanding those margins. They're showing they can grow and be highly profitable simultaneously.
Okay, so if we boil everything down, all this analysis, the split is kind of the shiny object, the noise maybe, but the real treasure is buried in those margin numbers. What's the final takeaway for, for you listening and trying to make sense of this?
Yeah, I think the key takeaway is exactly that. Don't get swept away just by the headline about a stock split. Yes, the split makes Netflix stock more affordable per share, at $110 versus $1,100.
Right, lower price tag.
But it's that expanding 31% operating margin, that incredible efficiency in execution. That's what makes the company fundamentally valuable. That's the true signal investors should probably be focusing on.
So bottom line, the stock split alone, not the reason to buy Netflix. It's the $33 billion in growing revenue. It's the super efficient, industry-leading profitability. That's what makes it a potentially compelling choice.
Precisely. The split is really just the mechanism that makes it easier, democratizes access maybe, to owning a piece of a company that's arguably earned its premium price through performance.
And that connects perfectly to a final thought, maybe something provocative for you to chew on after this. Remember how Netflix explicitly said their main reason for the split was accessibility for their employees, for their stock option program?
Right, yeah. The internal motivation driving this market move.
So think about the potential long-term ripple effects of that. By making the stock feel more affordable, maybe more attainable at $110 a share, they could be significantly boosting internal ownership, intrinsic motivation for potentially thousands of employees across the company.
Interesting point, like aligning everyone's incentives even more strongly.
Exactly. So how might that broader, more accessible employee ownership, that incentive structure, how might that actually influence the company's long-term performance trajectory from the inside out? Could that internal alignment, helped along by the split, actually help solidify their dominance even further down the road? Something to mull over?